Hey there, YouTube. So this week we're going to discuss the FOMC meeting that happened this last week. We're going to unpack some fascinating data that they highlighted and that they spoke about. We'll look into that here in a second. And then at the end of the video, I'm going to show some potential candidates that may have some opportunities with higher implied volatility and will make some good candidates for put sales. I will get into that at the end of the video. And then if you have any questions, please feel free to drop them in the comments. I will do my best to answer them, and I will potentially bring them up in our next video. By the way, I will be out next week. I'll be traveling next week, so I will not have an economics outlook, and then I'll answer it the week after that. So with that, let's go ahead and jump in. All right, so this week, Tuesday, we had retail sales. Really didn't matter because all eyes were on Wednesday, but retail sales continue to show strong. If you look there, 0.6, month over month, the consensus was 0.2. So the consumer's still feeling quite good and still spending quite well. And then you had building permits if you're into housing stocks, and then the Fed decision. We'll get into that here in a minute. But before I do, look at the initial claims. Remember last week, we had 263. It was revised upward to 264. And then this week, we got it, 231. So it was an anomaly last week, not a trend. I was interested in seeing if it was a trend. It doesn't look like it's a trend yet. The government layoffs, if any of those will be coming in towards the end of September into October. So I'm interested to see that. But for now, no big deal. But let's take a look at the FOMC and their interest rate decision. As expected, a 25 basis point cut. There was a chance of a 50, but it actually came in at 25. Not surprised by that at all. Let's look at their forecast. We also got their summary of economic projections. This is where they think GDP, unemployment, PCE, and where their Fed funds rate is going to be in the future. So we started out this year at that 4.25 to 4.5. The overnight rate's been 4.4, which is always somewhere in between here. And now they're penciling in 75 basis points of cut. We just got one. So that's two more cuts. So probably October and December, we will get a cut. Here's the dispersion of the votes. Got a pretty big dispersion. And then next year, one cut. All of the participants are expecting one cut at an average. One cut next year, one cut the year after. I don't know. I think that's a little bit light. And then overall, higher neutral rate. This is where the Fed is expecting neutral rate to be, is somewhere around 3%. This is the rate at which the economy doesn't grow too much and doesn't decrease too little. So it's just that perfect spot. And that's what the Fed is thinking. Now going back to here, I'll give you one guess who that guy is. That is the new person that Trump just added to the board. This is Stephen Myron. So who's Stephen Myron? Just a little bit of history. He's a Harvard grad, PhD in economics. Scott Bessent, the Treasury Secretary, nominated him in the Trump campaign. Myron donated to the Never Surrender Political Action Committee and to the Trump 47 Committee. Trump also nominated him to be the chair of the Council of Economic Advisors. So Myron works directly for Trump. And as the chair of economic advisors, he was the mastermind behind the Trump tariffs. He's a big supporter of the One Big Beautiful Bill. And the sticky point becomes where he is wanting some reforms at the Federal Reserve. He accused previous chair, Janet Yellen, of manipulating Treasury securities. And now, last year, has indicated that he wants shorter terms for the governors. Don't have a problem with that. But he wants the president to be able to have dismissal powers, which means that the president would then be able to fire anybody he wants. And that's a big problem. And I'll tell you why. The Fed needs to maintain central bank independence. If the government is controlling the Fed, then they'll be able to control rates. Then it'll be very political. The market will not like that. If you were to see the Fed bank independence be eroded, you will see long-term interest rates rise. This will be a very bad thing for the economy if the government is controlling the Fed. Again, it's one person, but this is his belief. The other sticky point is Myron has not been a big fan of Powell. Think about it this way. Myron is almost a spy inside of the Fed. Now he's going to see what people are saying. He's going to see how people are voting, and he'll be able to report that back to the president. That's going to be interesting to see how this plays out, because is the president going to go after another person besides Lisa Cook? Is there someone else he's going to try to go after and fire and try to get more and more people that are Trump loyalists so that they can vote in favor of that? That dot, I guarantee you, was Myron. He's the dissenter. We'll find out who the other dissenters were in 3 weeks. All right, so getting back to the forecast, let's take a look. This is the summary of economic projections. If you look down, I'll draw your eyes down to the change in real GDP. You can see that the Fed is more optimistic than they were in June. So we get this every quarter. And in June, they were predicting GDP to be 1.6. They're expecting that now to be 1.8 at the end of next year. At the end of this year, they're expecting it to be 1.6. So they're more optimistic. Unemployment, they're expecting that to stay the same, what they forecasted in June, to what they're going to expect in December. But look at next year. They're expecting a drop in unemployment from 4.5 to 4.4. So they're more optimistic. PCE, 3.0. It's actually, I think, 2.9 is what's forecast by the end of the year. They kept that the same. They're expecting PCE to stay up from 2.4. They thought they were going to get a little bit better handle on it by the end of next year because of the sticky factors of inflation. That's going to stay higher. And then they don't get to 2% until 2028. And that's the Fed's target. So another 2 years before inflation gets down to 2%. We'll see how that plays out. This is just a forecast. If there's a lot of softening in the labor market, a lot of softening in demand, you could see that fall. My personal opinion, I don't have a dog in the fight either way, whether it's going to get down there faster or not. It doesn't really matter. I think the inflation job's done. I think it's coming down. PCE, the core PCE, again, 2% by 2028. They're expecting for their overnight rate to be now 3.6. The last 2 quarters in March and June, they were expecting 3.9. And now they penciled in that other third cut. But one more cut, so 3.6, 3.4, it's 25 basis points. They round up. So one cut here and one cut here. I do think that's a little bit light. Let's look at some of the key takeaways. So they highlighted that the risks now are not inflation, but a higher risk to unemployment. And they took the cut because they want to get ahead of the unemployment potentially increasing. They will continue to reduce their security holdings. I've never showed this slide before, but this is the Federal Reserve balance sheet. This is the reverse repo and the bank reserve. So any money that's not lent out is put in the Fed. I work for a bank, and we have our money at the Fed. Every bank does. The reverse repo market is very similar to the Fed. It is actually the Fed, but it's different than banks. So think hedge funds, things like that. This has been coming down. It's been coming down. They're drawing money out of the economy. That's why interest rates have been higher. So money is coming out of the market. And then they're going to get to a point of ample reserves. Ample reserves is somewhere around the 2.5 trillion mark. We know that because a few years ago, September of 2019, barely made the news, but there was a blip in interest rates where interest rates were around 0 and all of a sudden overnight they shot up to 5%. Nobody knew about it because the Fed stepped in very quickly and had to buy a whole bunch of holdings in order to prevent the rate to continue rising. So it was like September 19th, I believe, of 2019. So we know that's where the market will break, is roughly that was 1.6, 1.7 trillion, maybe 1.8 trillion. So we're putting a little bit of buffer in here. 2 to 2.5 trillion would probably be what they consider ample reserves, where the Fed does not have to step in and control rates. One more thing, this blue line here is the reverse repo balance. So this is reverse repo and bank reserves. This is just reverse repo. This is like your hedge funds. That's getting near 0. You're going to hear this a lot in the media if you follow economic news. People are like, oh my gosh, when it hits 0, what's the Fed going to do? I'll tell you what the Fed's going to do. The media likes to sensationalize things. This will reach 0. And then what they're going to do here is they didn't talk about it this last time about reducing holdings. They reduce holdings every single month. They will slow down the sell of what their holdings are. And then instead of seeing this sharp drop, they're going to extend this out. So they'll slow down their holdings where this will take several years. They're not going to just wait till it gets to 2.5 and then stop. So they'll bleed it off slowly. What that will mean is that there will be less supply of treasuries in the market, which is going to be good for rates because that means the people who buy treasuries, foreign countries, everything else, there's going to be less of that. So there'll be a little bit more demand, and that will cause rates to fall. But it'll probably do it slowly. It'll probably have a negligible effect, but still, it's an effect. And this is the IRS account, the Treasury account. Bassett wants to get this up to about 850 to 900 billion, and here we are, 807. Okay, so that's the balance sheet. Going down further, they talked about the labor market is softening. We know that. We're at 4.3%. If you were to take out the healthcare jobs, which is all the area that had the big ads last month, you would have actually had negative job growth. You've had 22,000 jobs added last month, and over the last 3 months has averaged 29,000. That's really low. You have a decline in labor supply. I'll get into that here in a second. A decline in demand. You guys have seen the JOLTS report. JOLTS are your job openings. In the past, a couple of years ago, you had 2 job openings for every worker. Now you've got 1 job opening for every worker. So there's not a lot of demand for workers. And then Powell noted some concerns around low hiring, low firing. If you have companies that they're not firing their people, but they're also not hiring anyone, what happens when companies are laying off? And we know that people are laying off. And the effect of AI is a productivity tool, so you won't need as many people. This is going to have an effect, and what happens with those layoffs, time will tell. Let's look at the labor supply and immigration. This was talked about in the FOMC meeting. So this is a chart of foreign-born workers and native-born. So here's your native-born. You have an increase in employment here. And then you have foreign-born, which you had immigration growing quite a bit. And then now look, definitely see a kink here with the immigration policies. I put this table over here, represents the same thing. This is in chart form just for a visual. Look at year over year. So you have 30.8 million foreign-born workers. A year ago, in August of last year, you had 31.6. So a decrease of 822,000 workers. It's definitely going to affect demand. It's going to affect inflation. Native-born workers is where the job growth has been. Same time frame, you're 129.7 to 132. So you've had the increase. Most of the increase has all been in native. Another thing to note is the Center for Immigration Studies has noted that the population of foreign-born people, all in, workers, non-workers, has dropped by 1 million in 5 months. From January to May has dropped by 1 million. With 1 million people being moved out of the economy, if everybody's spending $4,000, that's $4 billion being removed. There's no longer being spent. That's definitely going to have an effect on inflation because there's just not enough demand. That'll affect prices. So that was noted, and we'll see how this ends up playing out. So immigration is definitely having an effect on demand and labor supply. This was also noted by Barclays Research. They expected to see it slow to less than 100,000 jobs. This report was published in June, and they said that by the end of December, they could see job ads at around 60,000. We already saw it's 22,000 and 29,000 for the last 3 months. So Barclays was right. They hit the nail on the head. I do think you're going to see negative job growths here in the next few months due to immigration, as well as layoffs and things like that. We've been restrictive with rates for a long time. So while I agree with the 3 cuts this year, I don't agree with the cuts next year. Finally, we'll talk about the birth-death model, another thing that was noted. So we had annual revisions down by 911,000 jobs. The survey, the non-farm payrolls report that we get once a month, is a survey. It's a survey of 119,000 businesses. The response rates have fallen, and people aren't responding as much as they used to. So it's been a little bit problematic. But he also said this birth-death model is problematic. And then there's actually 8.6 million businesses. So you're getting a small sampling to represent the whole. What the birth-death model is the births of businesses and the deaths of businesses. So they have to fill in the gaps of the other 8.5 million, roughly, businesses. They're filling the gaps by the birth-death model. And the birth-death model is how many businesses are born and how many employees are added, how many businesses go bankrupt, and how many employees are affected by that. And they're using that model to fill in the gaps. And birth-death model works for the most part, except at the peaks and troughs of economic cycles. Economic cycles look like this. Okay, so this is your trend. And where the birth-death model gets inaccurate is here at the peaks and the troughs. And the reason that is because they're taking a historical analysis of how many people are added and let go when these companies are born and go bankrupt. And they're using that as a trend. The problem is it's several months old and it's always lagging. So here, if you're at the peak of the cycle, you're going to be using data from back in this point here, and then you're forecasting. It doesn't catch up. The other thing that the birth-death model is, this annual revision by 911,000, is you have the survey, which is a small sampling, and then every quarter you get a quarterly wage assessment, which is much more accurate. The problem is it's several months behind. Even though it's every quarter, it's about 4 to 5 months behind, which is why this annual revision is just through March. So with that being 4 to 6 months behind, this is why this part here becomes extremely inaccurate. It is correct as long as you're growing and you're growing over time. Let me put it this way. It's the broken scale effect. This is a statistical thing when you're doing analysis. What happens is, let's say you're a 200-pound person, but you get on the scale and it shows 250. It's inaccurate. But the next month, you get on the scale and it shows 260. It measures the rate of change. So the rate of change is correct, but it's still inaccurate. So the next month after that, it shows 270. All things being equal and all things being measured the same, the rate of change is correct. So you had an increase of 10 pounds and an increase of 10 pounds each month. That part is right, but it's still inaccurate overall. What ends up happening is you're still measuring this rate of change. That is correct while you're in a trending environment. The minute you have this cycle going on, then it's definitely less accurate. And this is why you are getting these big decreases in jobs. At this point, you had one last year, you had one this year. I do believe we're at a peak, and that's why unemployment is beginning to fall. All right, enough about the birth-death model. Let's go back into what the Fed is thinking for unemployment. They're expecting 4.5 at the end of the year. This is a one standard deviation from the mean, so it could be as high as this, and it could be as low as this. Here's where we are for inflation. They expect inflation to keep coming down, but again, with one standard deviation from the mean, 70% confidence interval, it could be as high as this and down as low as this. How did rates respond? First, here's the overnight rate, and we see the cut. And now they're saying next month there's an 8% chance that it'll stay the same, a 92% chance that we're going to get another cut and another cut. So that was priced in. They're saying one more cut at the first of the quarter, and the market is saying a second cut in June. But the Fed is saying 3.4. This is their terminal rate. Let's see, 3.4, roughly here. Either the market has it wrong or the Fed has it wrong. Remember, the Fed is a little bit more optimistic. So we'll see. Speaking of rates, let's see what happened with the long end of the curve. This is the 10-year rate. Here we are. I talked about this last week where it was pricing in a recession. And because of this optimism by the Fed, rates started retreating a little bit. And I do expect the 10-year rate to probably fall in this range. Me personally, I am playing it like this. So I've got it straddled here down to about here. So as long as this stays within this range, then I'll be profitable because I'm selling calls up here and selling puts down here. I don't think it's going to drop tremendously, and I don't think it's going to rise. I'm straddling the 10, the 20, the 30. I'm straddling all in this range. So I've given myself, if it goes up 12 basis points, as long as it doesn't go up more than 12 basis points, I'll be profitable. If it doesn't fall more than 20 basis points, I'll be profitable. What I'm doing, just a little trick here, is I'm not playing this around unemployment days. I'm only playing this around weeks that there's not a lot of big economic news. Like this next week, I'm definitely playing it. There's not a lot of news coming up. So I don't see anything out of the ordinary that would cause rates to fall or rise a lot. So I'm just straddling it. Take a look at the 2-year. I've been long on the 2-year. Get rid of this. I've been long on the 2-year, so, it's profitable down this way. And now we got some retreat. We might have more retreat. I do hold 2 years, but I'm not like playing anything in particular. I may buy more if we get a retreat back here. The jobs report will be coming in here. If this retreats back a lot, then I'm definitely add more. If it stays the same, I may just stay where I'm at. A lot of it will depend on what happens here, but this is a good proxy for the overnight rate. Or you can go out and buy the overnight rate and say buy ZQZ26 because it's only got one cut priced in next year. If you get 2 or 3 or 4 cuts, that would definitely be a good play. It's not financial advice, but if that's a play you wanted to make, you have to do your own research on that. But with Jerome Powell leaving and Trump putting in more and more people, I could see that the overnight rate's going to fall because Trump wants 200 to 300 basis points. All right, enough about that. Here's what's coming up for the next week. So we have Jerome Powell's going to speak here, probably going to be benign because he did everything this last week, so nothing new here. Durable goods, GDP growth rate, we get the final look at GDP. They do 3 of these. We get the final look. I don't expect a lot of movement here. And then you get PCE on Friday. This is the inflation gauge that the Fed prefers over CPI. But since they're highly correlated, don't expect a lot to change. My interest rate position will expire on Friday. And if it's like super profitable by Thursday, I'll just close it out and I won't take the risk. All right, the market. Look at the market. From here to here, September is the worst month of the year, and we're up 4%. Unbelievable. Pretty good run. I shorted each one of these spots here. I'm not short at this point. I'm neutral. I'm basically selling calls and selling puts in this range. Now, it's super difficult to not to want to short this because you're at a 23.4 PE. So what that means is, think of it this way. If I were to go buy this company, it would take me 23 years to earn that income back. 23 years is a long time, and especially for the market when the average is roughly around 17 to 18. So it's super high. Another way to look at that is if you take the PE ratio and you do 1 divided by 23.4 equals 4.27. My earnings yield is 4.27. I can go out and buy a 10-year treasury risk-free and get 4.13. So my equity risk premium is only 0.14. 0.14. So to take all the risk of, this is just how you compare different asset classes, to take all the risk that you have with the market has a distribution like this. So some years you're going to have down years. Some years you're going to have up years. So to take that risk, I can go put it in a 10-year treasury earning 4.13 today and not take any risk. So your equity risk premium is very small. You would expect an equity risk premium to be more like 5% in order to go buy. You will get that if the market retreats and you'll have a higher equity risk premium. But that's why I'm not buying the market. I'm not going to buy the market until we get a pullback of some sort, maybe 3 or 4%. Then I'm definitely going long. I will not be going long on the S&P. I will be going long on IWM, small caps, because we're in a rate cutting cycle and rate cuts will be more favorable on small caps because they're more debt sensitive. Look at this. IWM had an increase of 1.9%. XHB retreated. You remember last week I was talking about XHB. It was like 117. It fell back to 113. I am selling puts now at that 104, 105 point. AGNC, haven't talked about this guy in a while. This is one of my favorites. They pay about a 14% yield, and they are a mortgage REIT. They will do very well in this rate cutting cycle because they are based on the spreads between the 10-year and the mortgage rates. So they did have a pullback, not surprised because rates started going up, and they'll probably settle, and then AGNC may pull back a little bit more, and I'll be adding to the position. And then TLT. TLT is your 20, 30-year treasuries, responded well for the week at 2.8%. All right, high valuations, a couple of negative divergences here, some seasonal trends here. I really want to short, but I will probably play neutral because I think the market is, I don't know, not seeing the big picture. You can see the Fed day, it moved quite a bit, and from the bottom of this spot here up to here was almost 2%. So we did have a move because the Fed doesn't care about unemployment at this point. Finally, our last slide. Last week I highlighted these candidates for puts, so I sold some puts. Every one of these were profitable, probably made 2 to 3%. This week, I'm not highlighting which ones I'm going to do because I don't know which ones I'm going to do yet. I'll probably do FCX. I like this one. This one had a pretty decent pullback. And I'll probably sell puts around the 43 mark, but I will turn it into a bull put spread, which I will cap it at a maybe 41. So I'll sell a put here, buy a put. I'll give up a little bit of this premium, but it'll cap it. So if I just do it as a naked put and I sell it for 43, I'll get $24 for 1 week on an $860 margin requirement. So that gives me a 2% return. But if I cap it, I might make $21 or $20 on a $200 investment. So that'll be a much richer ROI if it stays above 43. Plus I give myself some downside protection. I'll do that probably on FCX. I don't think I'll do it on Netflix. I will probably do it on Newmont. I played Newmont in the last week or two. And I'll probably do it on Nike again. Nike doesn't report earnings until the week after next. So as long as I'm out of all of these by earnings and I will probably just do these for 1 week and just sell puts and collect 2 or 3 or 4% on this part of the portfolio. So with that, hope you enjoyed this video. Again, if you have any questions, please feel free to put them down in the comments. I will do my best to answer them either in the comment or in my next video. And I will not be posting a video next week because I will be out of town. But the week after, I'll be back in the saddle. So with that, happy trading and hope you have a good one. Thanks.